Understanding your company's profitability is critical for strategic planning, investor relations, and long-term growth. One of the most widely used financial metrics for evaluating profitability from a shareholder's perspective is return on equity, or ROE. ROE reveals how efficiently a company is using its shareholders' equity to generate profit. In this video, we'll break down what ROE is, why it matters, how to calculate it, and how you can use it to make better business decisions. First, let's see what is return on equity, or ROE. Return on equity, or ROE, is a financial ratio that measures a company's ability to generate profits from its shareholders' investments. In simpler terms, it shows how much net income a company earns for every dollar of shareholders' equity. Formula of ROE is net income divided by shareholders' equity multiplied by 100. This ratio is typically expressed as a percentage. For example, an ROE of 15% means the company earns 15 cents for every $1 of equity. To fully understand ROE, it's helpful to understand its components. The first component is net income. This is the company's total profit after all expenses, taxes, and costs have been deducted from revenue. It's found at the bottom of the income statement. The second component of ROE is shareholders' equity. This includes all capital invested by shareholders plus retained earnings. It's reported on the company's balance sheet and can be calculated as shareholders' equity equals total assets minus total liabilities. ROE is a key metric because it provides insights into how effectively management is using shareholders' money. ROE directly measures how much profit a company generates relative to shareholder investment, giving investors an idea of the return they are getting. A higher ROE suggests the company is efficient in converting equity into profit. Companies with consistently high ROE tend to have competitive advantages and effective management. ROE helps investors compare the profitability of different companies, especially within the same industry. It's a useful benchmark for deciding where to allocate capital. ROE can reveal how a company is funding its operations, whether through equity, debt, or retained earnings, and how well those strategies are working. Generally, a higher ROE is better, but what qualifies as good depends on the industry. For example, technology companies might have ROEs above 20%. Utility companies may have ROEs closer to 10%. Here's a quick breakdown. Less than 10% ROE means low profitability or inefficient use of equity. 10% to 20% ROE means reasonable to good profitability, and greater than 20% ROE means excellent performance, if not driven by excessive debt. But beware, an extremely high ROE may also indicate high leverage, use of debt, which can increase risk. To better understand what's driving ROE, analysts often use the DuPont analysis, which breaks ROE into three components. ROE is equal to net profit margin, multiplied by asset turnover, multiplied by equity multiplier. Here, net profit margin equals net income divided by revenue, which measures profitability. Asset turnover equals revenue divided by total assets, which measures efficiency in using assets, and equity multiplier, which equals total assets divided by shareholders' equity, which measures financial leverage. This breakdown helps pinpoint whether changes in ROE come from better margins, higher efficiency, or increased debt. While ROE is a powerful metric, it's not perfect. Here are a few limitations. ROE can be skewed by debt. If a company takes on excessive debt and reduces its equity base, its ROE might look artificially high, even if overall profitability hasn't improved. Secondly, it ignores future growth. ROE is a snapshot of current profitability and doesn't consider future earnings potential or cash flow. Thirdly, ROE is vulnerable to accounting practices. Different accounting methods, such as asset depreciation or inventory valuation, can affect net income and equity, which in turn affects ROE. And lastly, but most importantly, ROE doesn't account for risk. A high ROE might come with high financial risk if it's driven by leverage. Investors should assess the risk profile alongside ROE. If you're a business owner or manager looking to boost your company's ROE, consider these strategies. First of all, increase net profit. Improve operational efficiency, reduce costs, or increase pricing power to grow bottom-line profits. Next, optimize asset usage. Sell underutilized assets or increase turnover to get more revenue from each asset. Third, efficient capital allocation. Avoid unnecessary equity dilution and reinvest retained earnings wisely. And fourth, use of debt strategically. Using some debt can enhance ROE, but excessive leverage increases financial risk. While ROE is valuable, it should be used alongside other metrics such as these: return on assets, or ROA, which measures profitability relative to total assets, return on invested capital, or ROIC, which includes both equity and debt, earnings per share, or EPS, which indicates profit per share, and debt-to-equity ratio, which shows financial risk and leverage. Using ROE in isolation may lead to incomplete conclusions. Return on equity is a fundamental measure of financial performance, especially for investors and company leadership. It provides insight into how effectively a company is turning equity into profits, and helps compare performance across competitors and industries. However, for a complete picture, ROE should be analyzed in context, with an understanding of industry norms, company strategy, and supporting financial metrics. As a business owner or investor, monitoring ROE over time allows you to track performance, identify areas for improvement, and make data-driven decisions. Whether you're managing a growing startup or evaluating a blue-chip stock, ROE can be one of your most valuable financial tools.